Hey guys, so one of the other questions that I have received a couple times is what is a share or stock? So essentially, when you're buying a share or a stock on the stock market or share market, you're buying a part ownership in a company, um, and that company will have assets or stock, and you'll get a share. You'll receive a share of the profits of that company. Uh, So that's the basis of it, and so the principle of a company is usually where it's set up as a separate legal entity whereby multiple individuals can put their capital into usually in the beginning, a new venture um, that allows them to pool their resources together and reduce the risk of some new business venture. And then as a result of receiving shares in the new company, as a shareholder, you're entitled to vote in directors of that company who then manage this separate legal entity, almost like it's an individual pursuing a business venture. But a lot of the time business ventures can be, either too financially onerous or too risky for a single individual to undertake. And that, you see it a lot these days in regards to maybe like a tech startup, or a mining exploration company, or a biotech company where a lot of investors put in a small amount of capital, not all their life savings, which allows them to take a risk. It's a high risk proposition, but potentially with a high payoff, in the sense that if you invest in a biotech company and they cure cancer, you might be able to there might be 50 biotech companies trying to cure cancer, but maybe only one of them will. And so as a result, it's a high risk proposition, but it's got a potentially really high payoff. So a company helps facilitate spreading of that risk and combining the resources to achieve that outcome. And that outcome might be very expensive to hire all the scientists and do all the testing to cure cancer. And actually the derivative, oh sorry, not the derivative. And actually companies were a financial innovation back in the early 1600s, mainly relating to like merchant ships and merchant traders. I think the first major company was the Dutch East Indies Company, which basically was just a bunch of merchants who came together to build a sailing fleet that went over into the East Indies, which is sort of the Indonesia, India, China area of today, and to transport goods like spices and materials to and from Europe. And that was very profitable because previously you used to travel over road, which was sort of safer but more expensive to do. So these guys came together and were able to build more ships, which reduced their risk and spread their risk out and increased their profits because they got more scale, which allowed them to be more efficient in their operations and made them more profitable. So a bunch of merchants coming together made more sense than individual guys trying to sail over to Asia and the East Indies, because it was a very dangerous journey. Ships got lost, and if you put all your money into one ship and it sunk, you might have bankrupted yourself. So it was better to do it together. And I mean, that first company continued operating for 200 years, as I understand it, and was very, very profitable. And yeah, so that's the premise of the company, is to bring people and resources together to create an entity that is more profitable and more stable than what an individual could do by themselves. And yeah, so in the modern day, like, we as shareholders, when you buy a stock or buy a share, is that you get to choose directors who manage and run their company. And it's the same principle with all companies. Even a small startup might only have 2 or 3 shareholders, or maybe even only 1 shareholder in the company. But those smaller companies, often if you only have a couple of shareholders, they'll probably all elect themselves as directors, and they become a board of directors which chooses the direction of the company. And I mean, the premise behind the company and the advantage of that financial innovation was that sometimes, a bank may be unwilling to lend debt to a new startup because, I think I touched on this in the previous video, is that debt often comes with like it is very structured, and there's a date that the debt matures where you need to pay all the money back, and you've got regular interest payments, and if you don't make them at regular intervals, you go into default, and that means that you'll have, you know, covenants that you'll breach, and those creditors will then have rights to recoup their assets if you're not paying those interest payments on the correct schedule and stuff like that. So that's not always the best way to start a new business venture. Sometimes a new business venture, you can't be certain of when the cash flows are going to come, and or if they're going to come, or to what degree they are, or yeah. So you want a bit more of a flexible financing arrangement, which is what a company allows, when people can inject their equity or their capital into a company, because I guess you could look at a company and a share as like a perpetual loan, where you take maybe $1,000 and you put it in a company, and you basically, or at least if this is the start of a company, you're permanently giving that capital to this new entity. And if there's 100 shareholders in that company, you don't, as a shareholder, don't usually have the right to then go to the company and go, I want my money back. What would happen is you take your share of that company, and then if you want money back for that investment, you would then sell it to someone else, whether that's an existing shareholder or someone outside the company, share registrar. And that's, I guess, the basis of stock markets and share markets, and how they formed was that you have these entities that had perpetual capital put in them, and then if people wanted to get their money out of those companies, they'd sell their share to someone else. And so, yeah, and that's how stock markets came about, and that's why we trade, buy and sell shares to one another. And you're basically trying to buy a company, and so when you're buying that company, you're really looking to buy companies that have, you know, good assets and good prospects for future profits. And yeah, that's the principle of what a share is, and sort of how companies came about, and how stock markets formed. And there's just other advantages to using a company structure or a share market structure over and above using debt. You might find if you start a company and it's really successful and you build it up over 20-30 years, it becomes quite large, and all of a sudden, if you want to sell the shares of that company as a going concern, and if it was originally a private company, you might be thinking, oh, okay, well, maybe my company's worth $50 million. There's just not a lot of people out there in the world that have $50 million, and there may not be a lot of banks out there willing to go to someone, hey, you can borrow $50 million off me to buy this private company. So then you find that people go, oh, my company's worth $50 million, I'm going to IPO it, have an initial public offering. And you know, you'll hear about companies like Facebook and Google and you know, Tesla or whatever, all going IPO. And that's how they, I guess, sell their shares to the company and then put it on a public stock exchange that allows people to trade it publicly. Yeah, so selling shares in a company on public markets can be a way of, an effective and efficient way of selling stakes in a company, and that's why a lot of people opt to do that, because it's very difficult to do it privately. So ultimately, any share or stock you buy should be hopefully be a perpetual investment that allows the directors to take the existing capital of the company and produce a return every year. And then if they do produce a return every year, at that point they have the choice then to either reinvest those profits back into new opportunities that the company feels that it can capitalize on, or distribute back to you as investors in the form of dividends. And you could think of that as a bit like, you know, if you put your money in a bank, you get interest back. If you put your money in a company, you get dividends back. So hopefully you get dividends back if it's a well-run company. So that's the principle of what a company is and what a share in companies are, and stocks. And hopefully that gives you the foundation of how to think about the sort of companies you want to buy, and that you're buying a part of something and you want to see what the assets of that something is and what the potential profits in the future for that share is. Alright, I hope that explained it all. I'll see you guys in the next video.